Hey, welcome. Hey, this is Kurt Frankenberg, joined by Mr. Good-Looking himself, Mike Chupka, over on the East Coast. Hello, Mike.
Hey, Kurt. How are you doing this fine morning where you are, fine afternoon where I am?
Well, this fine afternoon, it's snowing in Colorado.
Interesting.
I guess, yeah, it's a disadvantage, I guess, of living in a mountain community and in Colorado. We're supposed to have 80 degrees on Monday, but last night it was below freezing. Yeah, crazy stuff. Well, hey, folks, I sent out kind of a provocative email, and I don't know if everyone's here because of that email or if you came for other reasons. But I did make the assertion. I said cover calls are for suckers, and I'm sorry if that offended anybody. But we are going to take a baseline test here and see how happy everybody is with their trading. And we're going to.
Oh, Kurt's sound, ladies and gentlemen, I think has just dipped out. Hopefully you all can still...
How about now? Can you hear me?
Yes, sir. Mm-hmm.
Oh, thank goodness. Okay, got it. I think I know what happened. Okay, so, all right, so Mike, let me run a couple of polls here so we can get to know our audience just a little bit, okay? Would like to know what your involvement is with rate trading now. For example, you may have just picked up the Sketch white paper that talks about the trouble with cover calls, and it also talks about the solution, you know, that I believe makes sense to folks that own stock and want to cause their winners to run and cut their losers short. If you're coming to webinars, let me know. If you've been checking out the YouTube videos, that's a good source of information, and also it's free. If you're thinking about buying the blueprint, or if you already own the blueprint, please let me know. Blueprint, of course, is an expanded version of the Sketch. In fact, it's expanded all the way to about 250 pages. And we've got a lot of folks coming in saying that in fact, that looks like our biggest respondent there, Mike, is folks that are already on the blueprint. So that's marvelous.
Okay.
Okay, I'm going to leave that poll up for another 5 seconds, and then we'll close her up and ask the second one because I'd like to know what kinds of strategies folks are using. Okay? All right, so in first place, we got folks that already own the blueprint. That's great. Oh, no. In first place. Sorry, we have folks that are coming to the webinars. So very good. All right. Now, I'd like to see that number of folks that got the Sketch. I'd like to see that number jump to, let's say 100%, because it's a free white paper. It's available on radioactivetrading.com, and we'll show you exactly how to solve this problem that trading cover calls presents. Okay. All right. Let me go ahead and close that, and we're going to do a second poll and get into something I think will shock and amaze you, and it's also kind of cool. And it's a comparison of an actual cover call trade with if we had done it according to the dictates of the blueprint. Okay. All right. So what kind of level of difficulty are we using here, folks? Do we not trade options at all? Are we trading cover calls? Are we using long calls and puts or spread trades? Are some of you trading naked calls? Mm-hmm. Which to me is, I'm cleared to trade naked calls, but I don't. I'm just not that confident, Mike, in my abilities to predict what the market's going to do. And since naked call presents unlimited upside risk, I don't do it. Some folks do. It looks like a lot of folks on today's line. Okay? All right, let me go ahead and close this, Mike, and share the results. And we've got a little more than 7 out of 10 doing cover calls. All right, so this is a good audience for what I'm going to share today. 59% doing long calls and puts. Okay, very nice. And 47% doing spread trades. That's good because we're going to show 2 spread trades that are riskless. 2 spread trades that present no risk at all to the trader, and that's kind of an exciting proposition. And of course, 9% are doing naked calls. Okay, Mike, let's start off with this. I'm going to compare some hedge strategies, okay? We're going to compare owning long stock and shorting a call, and owning long stock and buying a put option. This is actually a YouTube video that I'm showing right here. This presentation that I'm going to show here is about a 5-minute YouTube video that you can also look at after you check this out today. Now,
Okay.
Mike, a lot of folks are leaving the covered call strategy. I call it the gateway drug because almost everybody that gets involved in options began that way. They began with trading covered calls. That includes you, doesn't it?
Yeah, and it's not just because it's the most popular strategy that's taught. I mean, if you do a Google search for covered call courses or covered call education, you're probably going to get swamped with links for books, products, books and CD products, $2,500 weekend seminars to learn how to trade covered calls. But aside from that, it's also typically, if you've never traded options before and you apply with your broker to trade options, level 1 trading at most brokerage houses will just allow you to do covered calls and maybe buy long calls. So it's advocated by the brokers themselves that you have to get some trades under your belt to apply to the higher levels, where in level 1 all you can do is covered calls to begin with.
That's right. It is the first thing, and it's actually I believe that that they allow folks to do covered calls because it kind of finances everybody else. And I really stand by that, Mike. That email that I sent out today, it was the covered callers that kind of financed the game for everyone else, wasn't it?
In that play, yes.
Right. So let me go ahead and pose a question here, Mike. Okay, if it was anything else other than the stock market, and I came to you and I said, "Hey, Mike, you know, I got a couple of ideas here. I got 2 investment ideas. Now, one of these investment ideas has a limited profit potential. I mean, I'm going to probably make 3 to 6% if I'm right about it. On the other hand, if I'm wrong, I could lose up to, well, I could actually lose everything. On the other hand, I've got another investment opportunity that has unlimited profit potential. But if I'm wrong about it, and sometimes I am wrong. In fact, I'm wrong very often, Mike. If I am wrong about it, I can't lose very much. I can lose maybe, you know, less than 10%. Which of those options sounds better to you?
Well, if I'm looking for growth, naturally, if I'm looking for anything to expand my monetary value, I'm going to be really inclined to go with the second choice. I don't want to lose whatever, you know, a fair amount of what I'm investing, but at the same time, I don't want to cap my gains either. In short, I
Right.
want
So
to let my winners run and cut my losers short, don't I?
yeah, it's one of those sayings, a trite saying that that you hear a lot of times. Cut your losers short, let your winners run. Sounds a lot like buy low, sell high, right?
Absolutely.
When I first heard that, I thought, well, I'll do that. I'll just do that. That's how I'll win. Okay. All right. So, but Mike, what I'm showing here, this is the graph of a covered call trade. Okay. It has limited profit and a risky proposition to hold it. On the other hand, the second investment was exactly the description of a married put, where I have unlimited profit potential. It can go up as high as it wants to, but if it goes against me, I've already locked in my possibility of loss. I've already locked in a limited amount that I could lose. Okay, so that's really the way to go. But Mike, if you look at one of these covered call trading seminars, you'll look around the room, and what you'll mainly see is you'll see middle-aged, middle class or upper middle class folks with college educations. That's the main target that these covered call trading gurus go after. In fact, Mike, I fit that description.
Right?
You fit that description. All right, I think everybody in your office fits that description. So, but very often, Mike, we get kind of duped into believing that the covered call trading strategy is a great way to go. Okay, and here's why. Because the idea of taking income from a stock that you already own is kind of sexy. I mean, I like that idea.
Right.
I like the idea of instead of sitting on the stock, I'm getting paid. And another thing, too, Mike, is the idea of buying insurance is not. I mean, I can't tell you how many times I've been at the counter, you know, at a electronics store, and they say, "Now, do you want the extended warranty with that?" And I kind of go, I don't know. You know, because on the one hand, I don't want to get hurt. On the other hand, I really don't want to spend the extra money. I really just don't want to spend the extra money. And so maybe I'm just going to try and keep track of that thing and make sure I don't drop it in water. Or you get the idea? All right. Buy insurance. Yeah, go ahead.
No, I was just going to say, I mean, you go to buy a product, whether it's something that you had planned to buy that's a $150 product or something that's a $600 product. Well, you went with the idea of, hey, this is what's shown. It's a $600 product. well, I don't want to make that $650 or $700 by buying the 3-year insurance plan on it. I wanted to pay $600 today.
That's right, and the fact is, Mike, that sometimes it's a good investment, sometimes it's not. But I'll tell you what, the same instrument is available to us in the stock market, and a lot of folks don't like to do it. And the reason that they don't like to do it is because they think, well, you know, it's going to limit my profit. Well, I've put together this quick presentation because I made an assertion during one of these live webinars. We had somebody on there say that, you know, I made a really good profit with C-Trip recently. And of course, you and I, we said, well, good, you know. Of course, you did leave yourself open to the possibility of a terrible loss, but good for you, you made the profit. But I think you probably could have made more with a married put, and she wasn't convinced. So we actually used the historical suite of option trading tools over there at Power Options, and looked back in time and said, okay, now if on the same day we bought exactly the same stock as our listener did, if we bought the same stock, but we insured it with a married put instead of selling a covered call against, would we have done better? And the results didn't surprise me, but they've surprised a lot of folks since. Okay? All right. So selling a covered call limits your profit on a winning trade. A married put does not limit your profit. Okay? All right, so let's say we pick a winner. And this was our gal from the audience. She had bought C-Trip on November 4th, I think year before last, okay? C-Trip at 57.88, and of course, at the same time, she sold 3 covered calls, okay, at a $2.30 premium. Now that made the new cost basis of the stock $55. Oh, and by the way, the strike price is $60. Okay, she sold the $60 strike, and it was the November call. Okay, so her cost basis per share is $55.58. Okay, and her stock went up. What happened was there was an earnings announcement, and it did climb. Okay, now the thing is, the covered call caps the gain. And on November 20th, she had to sell her stock, her C-Trip stock, at $60. It was actually trading at 70 and change. I think $71, $72. But she had to sell at 60. Okay. And her cost basis, because of selling calls, was not 57.88. It was 55.58 because she brought in that premium. Okay. So she made money on the premium. And she also made money on the capital gain of the stock, right? So that's a $4.42 per share profit. Really not bad. Okay, that is a decent return when you think about it. $4.42 per share return on a cost basis of what was it, 55.58? No matter how you describe it, that was good. She made a $4.42 per share profit. Times 300 shares, that would be $1,336. Okay, and it was if you divide that 442 by the 55.58 that she's invested, well, Mike, that's pretty sexy. I mean, that's 7.9%. She didn't even have to hold the stock a whole month. It was 16 days. Now, I'm going to do something here that I don't like to do myself, but I've seen the covered call trading gurus do this over and over. So I'll go ahead and do it. What they do is this annualized return type here. It implies that every single 16 days I'm going to be able to do this. So now I've got an annualized return, okay, of 181 because, gosh, I only had it for 16 out of 365 days. Does that make sense?
Right.
Right. Okay. All right. So it's 181% annualized return. Okay. All right. But no matter how you describe it, that was a really good return. Okay. So what a covered call is, Mike, is taking your long stock and mixing it with a bearish position for a hedge. You know, if C-Trip had gone down, she would be hedged to the tune of like $2.30, right?
That's right.
Yeah, $2.30 income is what you would have. Now, the stock could go down by more than $2.30, and then the hedge would not be as attractive. Okay, but she did have a little bit of a hedge. But I'm going to say instead of hedging with the short call, let's hedge with a long put and see if that makes a difference. So, same day, we pick up the same stock, same cost basis. And then instead of subtracting from the cost by selling a covered call, we're going to add to the cost by buying a long put. Now, Mike, these puts are kind of different. What's different about this married put position from, say, a regular married put position?
Oh, well, if you've ever read any free information as your broker or any free education on the internet about a protective put strategy or a married put, it's commonly defined as purchasing shares of stock. Here we have it at $57.88. But buying just a 1 month or 2 month output, maybe a December or a January put that's below the current stock price, that's out of the money. So I might have bought C-Trip at $57.88, maybe bought the 50 or the 55 put for December or for January, so I'm only paying 80 cents or 90 cents. Well, the problem is the stock still needs to drop 5, 10, 15% before that insurance policy kicks in. So I'm still taking on a risk where my insurance isn't intrinsically placed. The stock needs to drop before the insurance comes in. And I have such a short time frame that if I'm trying to buy puts continuously over and over, I'm going to greatly increase my annualized return. What you've done different here is take advantage of those axioms that are common with option buying and option selling. Rather than buy an option short term, whether for protection or for speculation, you bought it far out in time to give the stock more time to move in your desired direction and pay essentially less per day, assuming that you did hold it all the way to June expiration, but we'll get into that later in the presentation. And also you're going in the money so that it does look like you're paying a high amount of premium. It looks like your break even here is $71.58, but that's only if we hold the position all the way to June expiration. A lot of that $13.70 you're paying is in the intrinsic value that's already covered by the difference of the stock price to the strike price.
That's right. Most of that is already most of that cost of that put I am guaranteed to get back. In fact, if you look to the figures that I've now added here, Mike, because of that put being at the $65 strike, I'm guaranteed to get at least $65 out of this, right?
Yes.
So the at-risk amount is the difference between the cost basis and that strike price, or only $6.58. So out of this $13.70, only half of it am I risking. The other half is kind of like on deposit. Okay. All right. So so now when we divide that $6.58 by the $71.58, I've got a less than 10% risk.
Mm-hmm.
Okay. So let's see what happens. All right. In the same time frame, let's just see what happens. Okay. Who knew that a better hedge would make for a better return? You see, Mike, did I have a 10% hedge with C-Trip when I'm trading covered calls? I mean, if the stock goes down by 20%, am I limited in my losses? You see, this was over.
No, you've collected a premium, of course. You've collected a premium on the position there that lowers your cost basis, but it's doubtful, even if it lowered it by 10%, if the stock drops 20%, you still have a 10% loss. Anything below that 10% is going to be an increased loss on the position.
Right. Okay. So, Mike, what happened was C-Trip went up right after that earnings announcement, and you could actually have closed it right then. It went up higher than that after this day, but I'm going to be real conservative and just use the numbers from the day after the earnings announcement. Okay. So this is the more conservative result. The C-Trip shares were at 72.19 if I just sold them. And then I would have to sell the puts too. Well, I wouldn't have to, but if I did sell the puts too, the puts have come down in value, haven't they?
Of course, they're going to decline in price as the stock moves up. You originally paid, what was it, 13x for it, $13.80, $13.70. I can't remember the exact price.
But yeah, $13, something like that.
$13, and now it's dropped down to $7.70.
Right. Okay. But in order for me to lose that $6, all right, the stock had to go up by $18 or $14. So that's okay with me. Anyway, if I close both of them, that's $79.89 back into the account, and the original expense had been $71.58. So the total per share back into the account is $8.31. Now, Mike, is $8.31 better than $4.42?
It's almost double, isn't it, Kurt?
Yeah. How about the dollar amount? With the cover call trade, it was $1,336 profit for 300 shares. with the married put, it was almost $2,500.
Mm-hmm.
What about the fact that I didn't have to hold this all the way till expiration? Mike, if I sell a covered call, I've got to hold it till expiration if I'm going to receive the entire benefit. Otherwise, I'm going to probably have to pay to buy back that call.
Mm-hmm.
And if I paid to buy back that call on the day after earnings and the price shot up, would I be paying what I got? Would I be paying $2.30?
Well, no, you're going to be paying the intrinsic value, the difference in the strike price of the call option to the current price of the stock. So you might be paying more into the position, and you didn't take advantage of the stock movement. And one of our customers, Lloyd, had written in and said, well, in this scenario, what would have stopped the customer you're comparing this with from just taking the assigned position and buying back in the stock? Well, remember, the 442 profit that was made put it at a cost basis of about, what was it, $62, $63? I can't remember. But the stock was trading at what, 72?
It was 55.58, and it was a $60 short call. The stock went to 72, so to buy back that call would be more than $12 in.
Right, and to let ourselves get assigned, let's say we took the capital in by letting ourselves get assigned. If we bought back in the stock, we're still paying $12 more to get in the position from what we received.
Exactly. And, by the way, now the earnings announcement has come and gone. There's no more volatility in the stock. You're not going to be able to get as big of a premium selling the next strike up, are you?
Right.
Okay. Okay. All right. So 7.9% in 16 days for the covered call trade, but you can make 11.6% in 9 days by selling right after the earnings announcement. And guess what? If you held for the whole 16 days, you could have sold for more. I was being as conservative as possible. Okay? And, of course, this annualized return deal, again, I don't believe in publishing annualized results because you can't do this every 9 days. All right? But if you could do it every 9 days, of course, that I guess would be better. Okay? So either way you slice it, Mike, we had a better protection on the downside with the married puts, right, than the covered call. And we captured more upside with the upside move with the married put than the covered call. Okay, and so that's why I published that email this morning, saying covered calls are for suckers. By the way, Mike, I was the biggest sucker. I don't figure everybody in this room, we've got 67 joining us from all over the world, 68 now, joining us from all over the world. I don't figure any of you 68 lost your entire savings like I did by trading covered calls. Okay, I traded covered calls and I did it kind of silly. I did it on margin, which is exactly what my covered call trading guru was telling me, and ended up losing everything. Okay, so anyway, Mike, I'm hoping that folks have done better than me. Let's run this other poll here. Looking back over the last 12 months, how happy are you with your trading results? Would you say, yes, I'm happy, I made piles of money in 2010, doing pretty good so far in 2011? Would you say, I'm happy, but I could stand to be happier? Would you say mixed emotions, I've won some but lost some too? Would you say that you're unhappy? And this is a tribute to my radio producer, Mike. My producer of my radio show told me one time I'd rather take a physical beating than a financial one. Or did your results just stink? Are you ready to throw in the towel? And for those of you that are joining us from outside the United States, throw in the towel is a reference to a boxing trainer. If a boxing trainer's if his boxer is losing in the ring, in order to save him from getting hurt really badly, he'll throw in the towel, which means I quit. So that's what that saying means.
My mom always said she invented that term when I was growing up, because when she was in the kitchen and when she was done cleaning or cooking for everyone, she'd throw the towel onto the sink, and that's where she said it came from. So.
Okay. You have to go with your mom there, Mike. All right, good. So we've got a very small minority on each side. 5% saying, yes, I made piles of money, and 5% on the other side saying my results sucked. Okay, so the other 90% is in the middle. 42% are happy but could stand to be happier.
Uh-oh. Looks like Kurt's system cut out again. I apologize for that.
I'm back, Mike. I'm back. Hello.
Fantastic.
I hope I'm back. Okay, Mike, those first two lines, they usually add up to about 20%, don't they?
Yes, yeah, usually we see about a 20%, 20 to 80 split there between those who were happy and those who were still unhappy with their trading results.
Right, mixed emotions or just plain unhappy.
Mm-hmm.
So that's how it usually works. But today we've got a huge amount of folks saying, yes, I'm happy, but I can say and be happier. That's great. I think that this may have something to do with the fact that we do have a large number of blueprint owners on the line. Let me go ahead and confirm that here.
It was 37%.
Yeah. What's your involvement with trading? Yep, 37% own the blueprint. Okay, so that's that may account for it. I can't guarantee that it does, but I'm pretty sure that it is. Okay. All right. Now I'm going to ask the folks that. Well, I'm going to ask everybody that's happy and everybody that's unhappy, if that wants to have better results. What do you think the biggest problem is? If I could wave a magic wand and give you one of the 5 things listed here, if I could solve one of the 5 problems listed here, okay, what do you think it ought to be? And Mike, you're sitting in an office, correct?
Yeah, I am. Sorry.
Yeah, I've got views on all 3 sides that to my left, to my right in front of me. I got views, and I happen to be able to see the mountains and so forth, and so I can give you a pretty good idea of where north is. But from where you're sitting, can you just point north?
Yes.
You can?
I can.
Okay.
Yeah.
Can most people in your office just, get inside and can most people in your office just, oh yeah, this is exact magnetic north and just point that way?
Well, magnetic north, I don't think most people would know that, but
oh, okay.
Compass
okay.
north, it's off of true north, kind of thing. But no, I think we could because we've been in this office for a few years. We know the surrounding area and which way the road goes right outside of us. But you put us in a different office, no, I might not know which way is north.
That's right. Okay. What my point is if you all took a vote, now that would basically, then you'd know, right? If you took a vote, the majority is going to be right, right?
Mm-hmm. Well,
no,
not all the time. I don't know how. I don't know how it works in the Dahmer party, but
What you're going to need is you're going to need a compass. Okay.
Mm-hmm.
All right. So I'm going to go ahead and close this and share the results. Mike, 5 different answers for 5 different questions here.
Right.
Okay. But I think that the top result here is I wouldn't mind losing some if I could limit my losses.
Mm-hmm.
Okay. That's the top one. If I could pick winners more often, well, that's the second place winner. Pick winners more often. Mike, I pick winners about 47% of the time consistently. That doesn't sound very good, does it? If I was going to subscribe to a newsletter that bragged that their success rate was almost half, man, would you be excited about subscribing to that stock picking newsletter?
That does not sound exciting to me at all, sir.
No, but Mike, I win overall. I win overall in the market because even though I lose more often than I win, right? Even though I lose more often than I win much more in comparison to what I lose. And that's really what I'm going to call the holy grail of trading. Okay, let's explore that, shall we?
Mm-hmm.
Let's explore that. I'm going to go ahead and jump into this other presentation here, and we've been running these polls. Okay, are you happy with your trading results, and what do you think you need to do about it? Okay, all right, Mike. We've already covered this idea, cut losers short and let your winners run. Mm-hmm. Does the strategy of selling covered calls or selling naked puts go well with that idea?
No, we saw that already on the profit and loss chart in the discussion of what type of 2 investments would you like to use. The general risk-reward profile of the covered call or the naked put reverses that concept. We sort of cut our winners short, but we still allow our losers to potentially run.
Now that's the biggest complaint I've ever heard from folks that have been doing covered calls for any length of time, is that it's like a sorting machine.
Mm-hmm.
It sorts the winning stocks out of your account and leaves you with the losers. And for folks on the line, if you If you agree with that, maybe text that in. Maybe if you're a covered call seller, a veteran covered call seller, maybe text that in that you're having that kind of result. What about this with the spread trades? Okay, vertical spreads, butterflies, condors. They certainly do a good job of predetermining your risk. Okay, which I guess is cutting your losers short. But do they let your winners run?
Well, no, they have a capped maximum risk on the downside, that's true, but you also have a capped gain, whether you're doing a neutral position where you have a plateau profit and loss chart, or a standard bull put credit spread still has that capped gain on one side or the other. Now, the real problem with the credit spreads is if you set it up specifically where you're looking for a high probability of success, either in an iron condor or in a butterfly, or I shouldn't say butterfly, but an iron condor, for example, or with a bull put credit or bear call credit, you're probably risking 5 times to 10 times as much as you can potentially make. So one loss can wipe out several profitable trades.
That's right. Okay, so unless you're able somehow to skew things in your favor to where you win more often, very much more often, you're going to get in trouble with spreads too. Okay, Mike, I got this weird idea about 10 years ago that maybe limiting my downside risk but leaving the upside open to where it could be unlimited potential gains, that was a better way to go. And so far, that's been a lifesaver, and it's worked in not just for me, but for hundreds of traders all over the world, thousands. It has become a bastion of safety in volatile markets. We got a lot of thank you letters in November 2008, for example. Okay. All right. So what's possible? I'm going to take us into this idea here. Remember, just a few minutes ago, I was mentioning that if I lose a little more often than I win, I still could make money. Okay. We're going to go ahead and take a look here at a resource on the Radioactive Trading page, and I recommend that everybody come and take look at this and play with this simulator yourselves. Okay, I'm going to give you the secret to making money, because not only myself, but every successful stock trader that I've ever spoken with uses this principle in one shape, form, or fashion. Okay, they use this principle that I'm going to show you. Okay. Mike, what we've got here is a trade simulator tool. This is inspired by an Excel spreadsheet that I made actually flipping a coin. I actually flipped a coin 100 times and recorded the results, and I had 55 tails and 45 heads. Now it's random, okay? For here, look at this. There's 52 wins, 48 losses. If I run it again, 41 wins, 59 losses. It's random every. If we look over here on the side, what we've got is a string of wins and losers. It's random, all right? And then, of course, it's tabulating the results over here on the side. Now, check this out, Mike. With a target return, let's just say we set up our trades this way. Target return of 10% if we're right on a trade, and a limit loss or a loss limit of 10% in case we happen to be wrong on a trade. We just get out at 10, okay? And we just flip the coin 100 times. Okay, if start with $10,000. Here we've got 56 wins. Can you jot this down? I know that you're real busy. Sounds like you're typing a lot, answering questions. Okay, but can we jot this down? 56 wins, right? At one point, we ran that account value all the way up to 38,000. At another point, could you jot this down? We had a low value of $5,003. That's
50%.
50% drawdown, okay? Oh, ouch. And then we eventually had a winning amount, or ending amount, of $20,168. Now, folks, this is not a projection. This is just kind of a demonstration of an example of money management strategies, okay? So if we've got 10% target return, 10% loss limit, this may be the result after a market where we do 100 trades in a row, okay? Pretty good. But, Mike, let me run this simulation again. Ouch. If we don't win often enough, we're going to get hurt. You see that? Took $10,000.
Page didn't. Oh, there we go. Okay, got it. Yes, got it. 49 wins. Right.
Yeah. So we've really got to keep our winners higher. Now, what was it on the last page that I showed you? It was 56 wins.
Yes.
And obviously 44 losses. We took the $10,000 all the way up to nearly 40,000, but we didn't know enough to quit then. And at another point, we hit a low value of $5,000, which is a 50% drawdown.
Mm-hmm.
And then finally, we ended up with how much? 20,000 and change?
Yeah, 20,168.
Oh, okay. Folks, I want you to pay close attention. I'm going to change this target return. You may think I want to raise it, but I'm not. I'm going to lower it. I'm going to lower the target return to 8%. But I'm going to also do this. I'm going to lower the loss limit to 4%. And then we're going to run that session again. Interesting. Wow. Mike, it's no secret that if you have more winners than losers, you're going to do pretty well.
Mm-hmm.
Let's run this again. Ooh. More losers than winners. More losers than winners. Let's take a little exploration here. $10,000 we ran up to a high value of $60,000, hit a low value of a nail-biting $9,511. Mike, what kind of a loss is that?
4.89%.
That was our lowest point along the way, and then was the win higher at the very end.
Yeah, it was well more than double what we would have had being right 56% of the time with the 10% win and the 10% loss.
Yeah. Folks, this is really, really important to understand, and most folks lose it because it doesn't seem sexy. Here's the deal. Did I raise or lower my target return?
You lowered your expectations for potential return from 10% to 8%.
Did I pick stocks better? Did I time it better or worse?
Well, you did it worse than the winning record, of course, the winning record we're comparing it to with the 10% because that was the highest return that we saw.
Yeah, I'd call this a winning record too, even though I didn't win as many times.
Mm-hmm.
Okay, the other record where we had a 10% target return and we're right 56 times, we didn't do as well. And we had a serious nail biter along the way. How about this, huh? What I've shown you folks, you know, I hope everybody grabs this, all right? Because maybe it's not sexy, but it's truth. This is how you win, is by keeping your losses very, very low. That's the only other thing. The only other thing was we kept our losses down in single-digit percents, down to 4%, okay? Mm-hmm. So don't take my word for it. Take your own. I'm not going to say 4%. I'm going to say 6%. Looking back over the last 12 months, if you had kept your wins, but your losses were cut from whatever they were, whatever they actually were, to 6% or less, would you be happier? Would you be happier with your trade? Now, I'm not even talking about having greater wins. I'm talking about 6% per trade, or if you diversify your portfolio, making it spread out to where one trade is 1% loss. Okay, 1% of your portfolio, or 6% of what's in that trade. That makes sense. Okay, so how would that change things? Would you have said, yes, I'm very happy? Did you say no or mixed emotions, but you would be happy? Did you have a losing year, but this would have made the difference? Would you have still lost, but lost much less? Or can you honestly say, you know what, Kurt, I never lost more than 6% on any trade. I never risked more than 6%, never had a loss of more than that, and I still didn't do well last year. That's a serious minority, by the way, Mike. And the folks that are in that minority, I'll tell you exactly what you're doing wrong. Let's give it another 5 seconds. Let that list populate. 3, 2, 1 more second, and close it. Mike, what was the very happy category before?
Oh, piles of money was 5%, and happy but could be happier was 42%. But the ones that said yes, I made piles of money was 5%.
Okay, the very happy ones, 5%. We've almost increased that tenfold. 48% would have said yes, I'm very happy. 20% said no or mixed emotions, but they would have been happy. They would have said yes, I'm happy with my trading. Okay, 4% had a losing year, but this tweak here would have made a winning one. 24% would have still lost, but lost much less. Okay, and 4% never had a loss over 6%, but still lost overall. Now, listen, if you're controlling your losses to less than 6%, I'll tell you what you're not doing. You're not allowing your winners to run. And looking at the trend of the market over the last well, almost 2 years now, more than
Mm-hmm.
2 years, I will assert that you are day trading or swing trading. You're not leaving your stocks enough time to mature. That's your problem. You're cutting your losers short, but you're not allowing your winners to run, and you got to do both sides of that. Okay, so that's what the 4% here that did control their losses to 6% or less, and still lost. Well, that's your problem. Okay, I would say try and rethink your time frame. Rethink the time frame of how long you're going to be in a trade. Okay, now here's the deal. I'm gonna show that. Did I show it or?
You're sharing the results. Yes, you're still sharing the results.
I'm still sharing the results. Okay, so 48%, yes, very happy. 20% would have been happy. 4% would have made a difference. Okay, so 72% say that they would have had a better, well, actually 96% would have been better off, right?
Yes, if we lost less, we still would have been better off than where we were.
Okay, good. I'm going to ask you to put a number on that. Just put a number on that. Put a dollar amount on how much better you would have done. If you didn't get it, if you don't see how forcing yourself not to risk too much could even help, then go ahead and say so. If you would have saved at least $350 on a bad trade, drop that in there. If you would be ahead by, just estimate 1,000 to 5,000, go ahead and say so. If it would have been 5,000 to 10,000, say so. And if this information would have made $10,000 worth of difference, guess what? I just put your kids through college. Seriously, because
Which college are you sending your kids to?
Well, let's think about this. How many more years will we be trading? Okay, $10,000. $10,000, but we're not talking about just 1 year.
Mm-hmm.
If folks on the line begin to practice what I'm talking about, where you limit your losses down to 6% or less, we're going to do very well. Do very well. Let me go ahead and close that poll and share the results. 6% didn't understand the math. Okay, they didn't understand that forcing yourself not to lose too much could even help. Okay, I think it's the same small percentage that also is swing trading and day trading. Okay, 12% would have saved at least $350. All right, good. That's the cost of the blueprint if you don't already own it. So we paid you for that. Okay, 29%. Be ahead by $1,000 to $5,000. What's the largest one? The largest result?
Unfortunately, it's greater than $10,000.
Okay, I'm going to say it's unfortunate or it's fortunate, and it just really depends on which way you look in time. If you look back in time, boy, that's unfortunate. If you look forward in time, hey, you know what? Now you have this information. I did this seminar about a little more than 13 months ago. Okay, it was April of last year in Colorado Springs. I did one of these classes live, and instead of doing this electronic polling, I saw everybody's face, so it went around the room. And one fellow raised his hand and said, "Try $30,000." I said, "Wow, you'd have $30,000 more in your account to trade with if you had done this." He said, "No, I'd have $30,000 more from one bad trade."
Mm-hmm.
It wasn't from his whole year of trading; it was from one bad trade. Okay, so. Okay, let's go ahead and go over this structure again, Mike.
Yeah, and we're going to pause. Yeah, we're going to pause when you pull this up. When you pull up the whole thing, we talk a little bit out because we have two questions that are directly related to the setup itself.
Okay, great. Shall we hit those questions now?
No, let's describe this position first the way you'd want to, and then we'll hit those questions after you describe the basic setup.
Perfect. Okay, network appliance. This is a loser, by the way. I like to brag about my losers. Network appliance got in at 56.50. At the same time, went several months out in time and bought an in-the-money put option, just like I showed earlier. Okay, and so there's a total invested here of $67.50, but because it's a $65 put, I can get out at $65. So my total amount at risk is $2.50, or 3.7% of the overall position. Okay, there's your less than 4% risk, like what we showed in the trade simulator tool. Okay,
right.
Now what we've got then is a married put setup. Okay, where if the stock goes up, we're making money. If the stock goes down, we're losing money, but we're not losing near as much. Okay, that break-even line, there's ways to deal with that. Okay, some folks believe that I don't make a dime until the stock hits 67.60. Okay, if my cost base was 67.50, but that's not really how it works. On the other hand, do you see this this amount that I could possibly lose here, Mike? Represented
Yes.
by the that's 3.7%. Well, guess what? There's three things have to be present for me to lose that 3.7%. You know what those things are. What three things have to happen for me to lose that that full 3.7%?
Well, this bend in the elbow here is at the 65 strike. One of the questions that we had, Lloyd wanted to know, I'm still having a problem understanding the guaranteed return at 65. It's not a guaranteed return, Lloyd. It's a guaranteed exit. That's what we just paid for. That's what we added the extra funds by buying the put into the position. That gives us the right to close the stock at 65. We have the right, not the obligation, that at any time between June today and June expiration, we can sell the stock at $65. So even if it drops down to $2 per share, I can get $65 back, and I've only lost the $2.50. Now, going back to that profit and loss chart, the three things that would need to happen is, well, the stock would need to be below $65. That's where that little elbow is right there on the profit and loss chart.
The stock would have to be down below $65. Do I have any control over that?
No, you have no control what the stock's going to do next.
Okay, what other two conditions have to be present for me to lose that whole 3.7%?
Well, you have to hold it all the way to June expiration. If it's 2 months from now, still, a couple months to June expiration, this is an older trade, so June expiration is next month. But at the time you open the position, if you closed it the next month, you would still have retained a lot of the time premium that you paid into the position. So you wouldn't be selling the close your put for just the intrinsic value. You would still have some time value remaining. So only if the stock's trading below 65, you hold it all the way to June expiration, and if you made no other adjustments on this position to lower that risk.
That's right. Now, I've got control over two of those three factors. I can't control what the stock is going to do, but I can control whether or not I hold it all the way until the end, and I can also decide whether or not I'm going to do income methods, riskless spread trades that are nested within this. Okay. Now I'll show. I made that assertion. It's a riskless spread trade. I'll go ahead and show it.
Let's pause
in a few moments.
Yeah, let's pause for a second while we're looking at this. The other question that came in, and we don't have to spend a lot of time on it because I've been talking with Roger, and I'm going to send him some links after the webinar. A lot of people will look at this and say, "Wait, can I do better, or can I do the same with just a long call position? Isn't that the same risk-reward graph that I'm looking at right here? Why put in all the capital if I can just do it with a long call?"
Okay. That's the question?
That's kind of the question, yep.
Okay. A lot of folks believe that a long call is the same as a married put, but it is not. Okay. There's a different amount of premium that is at risk, different amount of premium at risk, and more importantly, a different percent of what you're trading is at risk unless you're following very strict money management rules. For example, you've got to have the same amount of capital that you would normally put into buying the stock and the put. You've got to have that much capital on hand anyway and put it on deposit at interest in order to have the same risk-reward profile. Otherwise, it's completely different.
Right.
Okay?
So going
a lot of options educators gloss over that fact, but it's the truth. Okay,
right. So I was just going to say, going back to the other screen, let's just say you did 100 shares of your NTAP position, and you had invested $6,750. Okay. And someone might look at this and say, oh, well, if the 65 puts at $11, but the total at risk, the time value is $250, I probably could have bought a June 2011 65 put for maybe $260, maybe $270, for example.
Call, you mean, right?
Yeah, I'm sorry. Yeah. The June 65 call for $260, $270, maybe $275. So aren't I risking the same thing? Well, if you're disciplined and you if you buy one call that costs $275, so you only put $260, $275, a little bit different, into the position, and then you take the remaining $6,500 and put it into an interest-bearing account, now that might be considered a parity trade. If you take that $6,500 or $6,700 and say, oh, that means I can buy 20 contracts at $250, well, no. Now you're risking the full $5,000 that you paid into that position. You're risking 100% of that value, and that's going to represent too much risk on any one position. So those are the differences, but as I mentioned, Roger, I will send you some of the links. If you just go to radioactivetrading.com and click on the blog there, Kurt has several articles on comparing the married put and long call, and I'll send you some of those specific links after the presentation.
Very good. Okay, Mike, let's blaze through this, and then we'll show the riskless spread trades I was talking about. Oh, by the way, the end of the story with Intap was that I got out, and I got out with a 1.2% loss, even though the stock went down by 10.8.
Mm-hmm.
That's 9 times as big a loss. If I held onto the stock and took a 10.8% loss, that's 9 times as big as 1.2. All right, so I do like to brag about my losers. Okay, let's talk about 3 positions. Okay, straight stock, covered call, married put. Okay, if you had just stock and your stock goes up 20%, well, you make 20%, right?
Mm-hmm.
Your covered call is going to yield less because, well, you've made an agreement to take less. All right, and then the married put is going to yield less too. I'll be real honest. Your married put isn't going to make as much. But the reason that it doesn't make as much is because because you're buying into the insurance. The insurance policy does not go down dollar for dollar as the stock goes up, however.
Mm-hmm.
Okay, so you're going to still make some money. All right, now, new play. Let's say we put it into our winnings from that. We won in all 3 positions. Put it into new play and your stock goes down. Well, then you have a loss of 20% of the stock. Do you have as big of a loss in the covered call?
Well, no, you hedged it a little bit, right? You collected 4, 5, maybe 6% of premium. Let's just assume 5% premium, more volatile stock. So you lost only 15% as opposed to the full 20.
Right, but with the married put, you'd lose much, much less, okay, because of the way that it was set up, okay? So here's the deal. This was the same market. This straight stock made 20%, and then it lost 20%. So am I flat with that?
Well, you would think so, but that's not how it works. I mean, I made 20%, then I lost 20%. I should be at break even, but I'm not.
Right. What happens is we end up with a net loss, and it's not because of commissions. I mean, commissions will make it even worse, but it's because of percents here, because of the logarithmic and exponential effects that losing and making a percent have. By losing 20%, okay, or I'm sorry, making 20%, if I had $100, made 20%, that'd be $120, right?
That's right.
So I take my 120, and then if I lose 20% of that, 20% of 120 is $24. So I end up behind the curve, and that's how that really works. What about the cover call trade? Well, because it makes less on the way up, it ends up being a bigger loser than if you had just held stock. All right, so we have a net loss there. But here's the only one that actually did well, Mike.
Mm-hmm.
If a married put makes 15% on the way up, and then you put your funds into a new play, and it loses 5% on the way down, well, out of the 3 plays, all of which were bullish, all right, out of the 3 plays, this is the only one that has a net gain.
Mm-hmm.
Right, and that is the edge that's given by radioactive trading. Okay, we have the same market but different end results. We've skewed ourselves so that when we have winners, our winners run, and we haven't screwed ourselves because when we have losers, we cut them short. All right, and that's really the what gives the advantage. So what's different now? Well, what's different now is that this saying works. Okay, this thing right here, cut your losers short and let your winners run. That's just where we start. I'm going to go ahead and talk about this real quick. Just put up those poll results again. And this is from today's poll. Okay, if you kept your wins from last year, but cut your losses down to 6% or less of whatever they were, how much better would you have done? And 96% would be in a better position. 4% somehow still lost, even though they kept their losses down to 6% or less. Okay, so that's 96%. Then when we looked at the dollar amounts, okay, this is what radioactive trading has done for us far. All right, 6% didn't get it, but the other 94% would have made more money, or at least saved money last year. Pretty cool. All right, so what else is different? What else is different is that once you set up your stock and your put, that's not the end of the story. Okay? We can do adjustments that I call income methods. Income methods are adjustments, they're nested trades within your married put They're almost always done at a credit. That's why I call them income methods. Sometimes, however, you can do it at a debit to guarantee a higher payout. I'm going to show that too. Okay? All right, so here's another trade that I'm currently in. Humana with shares at $63.90 and the August 2011 $65 put option for $5.80. So that makes a total invested amount of $69.70 per share. And there's my guaranteed, what was the fellow that asked before? He thought we said guaranteed return, right? This is not a guaranteed return. It's a guaranteed exit. I'm guaranteed that I can get out at $65 because of that put option, right? Okay.
Right.
So the total amount at risk is the difference, the $4.70, all right, or 6.7%. Now remember, that's 6.7%, but geez, I don't have to hold it all the way to the expiration, right? And I can do adjustments. So I'm going to say that this is congruent with the 6% loss example. We'll see why in a minute. By the way, this is scalable, Mike. If you pick up 100 shares in one put, you could also pick up 200 shares in two puts, and it would still be 6.7% at risk. Could you pick up 1,000 shares in 10 puts?
Of course I could.
Yeah, and you'd still have 6.7% of whatever your capital is to trade at risk. Okay, kind of cool. So here's the graph. There's the familiar hockey stick pattern there of 6.7% at risk and infinite upside. The dollar amount here is $4.70 per share times 200 shares in two contracts makes $940 maximum risk. Now, that's not super sexy, but watch this. Okay, we've clearly risked $940. The bear call spread. What if we did a bear call spread, Mike, where we sold two 67.50 calls, April calls, and at the same time bought two $70 calls?
Right, and you're using the two because that's the number of shares that you have, right?
Yes.
Okay.
Yes. I have 200 shares, and I'm going to sell two calls against it, so that's a covered call. But using the proceeds from that, I'm going to also buy two calls.
Right.
Okay. So, and you can do this even with option clearance level 1. and the reason is, well, shoot, you're just selling a covered call, you're also buying long calls.
Well, if you own the stock, you can't do this necessarily by itself on level 1. But if you own stock or you have a Mary put in your account, your broker should just look at it as a covered call with an extra long call. Anyway, moving on.
That's correct. Okay. So here's the deal. I got 95 cents for these, and I paid 45 cents for these. So that's 50 cents per spread, and two spreads, so it's $1. You see that up here. Total cost is, it says $100, but it's in negative. That means I got paid $100 to put this on, right?
That's a premium you receive into your account, yes.
Yeah, but what's the problem with the bear call spread?
Well, you have to cover the risk between the strike prices. If the stock moved up to 72, 75, you're obligated to deliver shares of stock at 67.50, but you have the right to buy them at 70. So you've got to cover the 250 spread between the two. And since you're doing two contracts, that monetary requirement, the difference in the strike prices, would be 5 points. 250 times 2.
Okay, so it's 5 points, but I've received a point credit, so my risk is $400, right?
Yeah, the risk on this part of the position, on this spread by itself, would be $400. That's the maximum loss if the stock was above 70 at expiration.
Okay. All right, so we had our radioactive profit machine with 200 shares and two puts. That had 940 at risk. I just showed this, the bear call spread that has 400 risk. Now, if we add them two together, what should the total at risk be?
1340, right?
Well, that's what most folks think, but they're mutually exclusive. You see, this bear call spread takes away $100 from that risk, and this takes away all the risk from that. All right? Here's how it looks. All right? If we were to do a graph of it, and we've got all four legs in place, we've got our stock, we've got our put option that protects the stock, we've got our short calls, and we've got our long calls. All four legs. Looky here. Oh. It looks like a little heartbeat there, doesn't it? I know we have a lot of doctors on the line. We don't like flat lines, do we? This is a little better. If you'll notice here, Mike, the maximum risk has gone from 940 to now 840. Okay.
Yes.
The maximum risk percent has gone from 6.7 to 6.1. You know, this spread expires in April, but the stock has no expiration, and the put protecting the stock doesn't expire until August. right?
True.
So could I do this bear call spread again?
Well, of course, if it expired and you still had everything in place, absolutely.
I could do it again and again. Okay, all right. So let's look at a different kind of a risk deal. Okay, the bear call spread introduces no risk and it takes a credit. Kind of cool. All right, and you can do it repetitively to take out all risk. This is the power of income method number 6, and there's 10 income methods in the blueprint. Okay, now I'm going to show you something else here, Mike. This is called income method number 4, and I put income in parentheses or quotes here. Okay, because it doesn't actually take in any credit. Okay, all right. So Humana goes up. Can I do another trade to take out more risk? Okay, so Humana goes up. What if I could use the put? I know that a lot of folks look at that put as an expense, but I can also use that put as a real benefit. Okay, watch this. If the stock goes up, and so the put falls down a little bit. Remember, it had been $5.80. All right. Now the stock has risen enough that the put goes down to $4.10. But guess what? All the other puts are down too. If I was to sell to close that $65 put and buy to open the $70 put, I'm going to end up paying $2.80. Okay. Whoops, that's the wrong. There we go. Here it is, Mike. Look at the bottom 2 lines. Here we have the shares of Humana, the original shares of Humana, and here we have an August $65 put for $5.80. It shows me buying them, but then it also shows me selling them up here for less. Why am I selling for less? Well, because the stock is at past $70. Since the stock is past $70, the put price has gone down, right? But so has the put price of the 70. So I'm selling them for $4.10 and picking up the next for $6.90, a total debit of $2.80. But what am I also doing? I'm raising the guaranteed exit from 65 to 70. I'm going to start out with this position, and then, bloop, now I have less risk. Make sense?
Got it. We reduced our risk. Absolutely.
Okay. And in fact, I know that some folks are saying, wait a minute, Kurt, you didn't include the bear call spread. Well, okay. If we have the bear call spread and we have income method number 4, well, let's see how that works, okay? What we're going to do is we're going to add everything together. We've got a cost basis on this $70 put now. It's like we paid $8.60 for it. And we're going to also do the bear call spread, okay?
Of course.
And so now that takes our maximum risk. Remember how the maximum risk at the beginning had been 6.7?
Yes, that's right. That was our original at risk with the RPM setup.
Right. Now we're showing it at 2.8. Okay? And the upside, is that still infinite?
Of course, we have not capped our upside because of the idea of selling the short call. We did sell a short call, which would typically cap your gain on this position, but you also bought the extra long call, so the gain is not capped.
That's correct. Okay. Now, Mike, I'll just shorten the story for everybody. The expiration has come and gone for April, and it went against me with that bear call spread. The bear call spread went against me. But in order for it to go against me, I had to make money in the stock.
Yes.
And I was able to do this income method number 4 trade again. Ta-da! Okay, sufficient members saw this, and it says yesterday, but this is actually a couple of weeks ago. Okay, where I sold to close and bought to open again. It's a debit of $2.90, but again, I'm raising my put price by $5. Okay, so I'm spending $2.90 to get a guaranteed $5. That's a really good trade. Okay, and now we are bulletproof. Bulletproof means, and by the way, there's no more no more of that. It's just a flat line now. There's no more risk at all, and we have infinite upside potential. Now, Mike, I'm not going to cherry pick. Well, I am going to cherry pick right now. I'm going to talk about one of your trades last year where you repetitively did income method number 4. What was the risk? What was the risk that you started with?
7%, which, by the way, in case there are new people online, when you hear me on these presentations or on the Power Options presentations, you'll hear me say that 7% is the maximum risk I allow myself to take on one of these positions.
Okay, so you had 7% at risk, and then you did a one of the income methods that took a credit. It was a short-term play that took a credit and completely wiped out that 7% risk in the first month, correct?
Yeah, the actual monetary risk was $1.50 or 7% of what I had invested, and in the first couple of weeks I was able to sell a call option for about $1.48, which essentially canceled all of the risk that I started with in the first place.
Okay, so so after having canceled the risk, when that expiration came and went, now you were able to hold that for another 6 months. And during those 6 months, you actually didn't hold it all the way through the 6 months, but
No.
during that during that time period, you continued to do income method number 4 and roll it up, roll it up, roll it up. What was your profit when you finally exited the position?
Now, when I exited the position, when I was actually beyond my potential goals, it had kept exceeding my expectations, so I stayed in the trade. But anyway, what had ended up happening was that at the time I liquidated the position, I had a guaranteed profit, a guaranteed bulletproof position where I was going to make 29.6 or 29.8% even if the stock dropped 50%, 60%. I was guaranteed a 29% return. But because I still had time value left in the put, because one of those income method number 4 crits, I had moved it from December to March. So I still had time value left on the new put that I had in place. But when I liquidated it, I liquidated the position for a 59.8% gain. I was guaranteed a profit of at least 29.8, but because the time value hadn't decayed, I was able to get more when I decided to liquidate the position.
Right. So you began with 7% risk, and then you used an income method to reduce this this break-even point, right? You reduce the gap. When you reduce the gap to less than 0, then you're bulletproof. You can't possibly lose, but your stock can continue to go up, right?
That's right.
All right. And that's what happened with you with that particular trade. You got out at 59.8% gain. So 7% risk, 0% risk after that, and then finally, you know, a 59.8% gain. So what I like to say about trading stocks in the first place, this is kind of a catchy saying I came up with about 9 years ago. It's been copycatted, but I like to say don't pick stocks, pick stops. And then here's another one. Don't time trades, trade time. Each time you did one of these income methods, what you were doing was you were swapping time for premium. Or you were buying premium at a better level. You were swapping one position for another. And that's really the core of all 10 income methods. Okay, don't time trades, trade time. All right, so Mike, I'm going to ask folks on the line, what things did you like most about what we've seen today? We didn't do everything, okay? We can't. I mean, there's not enough time. All right, but did you like the idea of starting with very low risk in case you're wrong on a trade? If it goes against you, you don't get hurt too badly. Do you like the idea to the opportunity to adjust your risk and take income? For example, income method number 6 adjusted the risk down from, it was 6.7, it adjusted down to 6.1 and took a credit, right? Or do you like the idea of being bulletproof and still letting it ride? That's infinite leverage. I mean, once you have got your cost basis for both your stock and your put lower than the strike price of your put, how are you going to lose? You can't. You can't lose, but your stock can still going. Do you like the idea of taking income by way of spread trades that don't introduce any risk? Or do you like the idea that, geez, I've shown two, but there's different types of market settings. There's different types of things. You know, over the last 10 years, we've seen some really turbulent ups and downs.
Right.
You like the idea that there's 10 different ways to exploit those. Okay, so let me go ahead and close that and share the results. I'm going to say, what's our winner? Interesting. We've got a 3-way tie for second place. First place, possibility of bulletproof and letting it ride. How would you like to be? We don't know when this bull market is going to end, do we?
No, it may have already ended. We're not sure.
We're not sure. We're not sure. However, we are able to let it ride if it does continue to move up. But if it doesn't, you know, the trend is your friend till the end when it bends, right? If the market reverses on us, hey, guess what? How would you like to be bulletproof? Not be able to lose. That's kind of cool. And then ties for second place. All right. Started with low risk in case you're wrong. Opportunity to adjust risk and take income. And then taking income by way of spread trades that don't introduce any risk. That's kind of cool. Okay. Let me go ahead and hide those results, and we'll do a final poll, Mike. And just ask, guys, what do you want to know about? You want to know how to find these kinds of trades? Do you want to know if these income methods can be done in an IRA, or if your broker will allow the things that I showed today? Would you like to know how to get the blueprint and learn all 10 income methods? Do you already own the blueprint and want to know how to get more out of it? Cool. All right, Mike, I'm going to go ahead and close this poll and share the results. All right, first place winner. How do I find these kinds of trades? Guys, I could tell you, I'm going to go ahead and tell you what I do to find these kinds of trades, okay? And I send this to everybody. And Mike, I don't know if I'm still hearing you. Are you still online there, sir? Okay. Gang, I'm sending this out to everybody, all right? PowerOps.com/RAT. Power Options is the search tool that I use to find these kinds of trades. I used it to find a trade yesterday and documented it. And we're tracking that right now. We're tracking, oh gosh, I think more than a dozen trades right now that I used Power Options to find. A great number of those trades are already bulletproofed, where they can't lose, but they can win. All right. So PowerOptions.com, that's the deal. Second place, let's hear the offer for the blueprint. By the way, most of the income methods can be done in an IRA. And your broker will allow almost everything, even at options level trading 1. There are a couple of tweaks you would have to do for income method number 5. Some folks will not be allowed to do 7 and 8, but all the others are available. And when I first began selling the blueprint, it was just income method number 1 through 4. All right. So what should I do now? Mike, I seem to hear you again. Are you back on the line?
Yeah. Sorry, I rolled my chair back and didn't realize I unplugged the USB port for the headphones, so I thought I was still in line, and it turns out I wasn't.
I got it. All right. So so what we've got here, Mike, the first place answer was, how do I find these kinds of trades? And I told him about Power Options. We don't have time to go into all the Power Options tools, but I'll just tell you that as a customer, I received nothing but the best service. And about 3 years ago, I became partnered with Power Options, and they have continued to tweak and improve the tools according to the requests of both myself and also the whole community of radioactive traders all over the world, giving their suggestions. Geez, you know, this is what I'd like in the tool. This is what I'd like to analyze with. This is what I'd like to sort with. This is how I'd like to look at a before-after look if I'm going to employ an income method. Geez, I might even like some, you know, observations, some suggestions on what income method might be appropriate for my situation. Okay, all those things are included in the Power Options platform. Okay, what else should you do now? Well, the second place offer, 50% said, let's hear the offer for the. So I'm going to say, hey guys, we've shown you what the real problem is, how it's gone unsolved, and the viable solution. The polls have told us that 96% would have had a better result. 96% of everybody in line would have had a better result if they simply employed the principles found in the blueprint last year.
And the real question is, where do you want to be 12 months from now?
Yeah, 12 months from today. When we did a dollar amount, we found that for 12% of you, I paid for your blueprint. Okay, it says that I would have saved at least $350. Well, guess what? The setup that I showed you for free. So you've paid for your blueprint already. Okay, 29%, 1,000 to 5,000, 18%, 5,000 to 10,000, 35%. This information would have made $10,000 worth of difference. Okay, well, I think it's a no-brainer. Okay, you can see the difference. You start with very little risk. You can bulletproof yourself under certain conditions. Okay, if the stock does certain things, and you're able to bulletproof yourself, and you can even take income afterwards while leaving your upside open. The blueprint is and if you already own the blueprint, start using support. Okay, the first level of support that you have is support at radioactivetrading.com. Ask any question that you have regarding the income methods and how they apply to today's market, and we'll be happy to answer. A second level of that is Fission. Fission is a subscription service that you can look over my shoulder and over the shoulder of other successful radioactive traders. And
but it's really not a newsletter service, is it, Kurt? It's really not an advisory newsletter service. It's more of continued education on top of the principles, so you can see how these methods and these kind of trades are applied into the real market. Right.
It's ongoing education. We also do boot camps where time and again we'll take a look at a trade that we've recently done and what we did right with it, what we may have done wrong with it, and our learned lessons. We also share trades from other members in those boot camp sessions. As far as tools, Power Options has the best solutions. I think I already sent that link out to you. Mike, do you see that?
Yes, that link was sent, sir. Absolutely.
Good. That's for free. 2-week glimpse at the Power Options tools. But I'll show you how to get more than a week. Or I'm sorry, it's 2 weeks, right?
It's a 2-week free trial at powerup.com/RAT. But how can they get a month and a lot of other useful information as well, Kurt?
Okay, very good. What you get if you order the blueprint today, okay, you get 250 pages of instruction, and don't be intimidated by that. The first 3 chapters will start you making money, okay? The rest will, all 10 income methods, that's all about strategies that are appropriate in different markets and to different people. Some people may specialize in certain plays, okay, and you may not need to go through everything before you're already a successful radioactive trader. Okay, so don't be put off by that 250 pages. I just like to be thorough, and we provide a lot of examples and a lot of teaching. The 3 bonuses, there's that month of Power Options that we talked about, Mike. And it's the real-time quotes. Okay, the real-time quotes are $79, and you get it free with the blueprint for a month. Also, the Foundations of Radioactive Trading CD will talk to you about asset allocation. How much is enough and how much is too much? You know, the most important question to be answered in any investment is how much do I put at risk? And this CD answers that question, particularly for folks with larger accounts. Okay. The Quick Action Guide, $50 value. This will teach you how to convert your existing positions into radioactive positions pretty seamlessly. Okay. All right, so what it'll cost, it's $339 plus shipping. If your destination is in the United States, it's $11, so there's the $350 I was telling you about that we've already paid for 12% of you. Right, 12% of you? What was this again? Let me see. Care to put a dollar amount? Okay, 12% would have saved at least $350, right? Okay. And then, Mike, I'm going to do a final thing here. Whoops, did I hide it?
You're showing the poll results. You haven't hid them yet, sir. There you go.
Okay, good. How about now? Very good. Set. Okay, so Mike, if I made this $339 investment and it turned out that it was not right for me, how much could I stand to lose?
Well, $339.
Yeah. If it turned out to be the right thing at the right time for teaching me how to limit my risk and bulletproof some stocks and be able to leave the upside open so that my winners can run, then you know the sky's pretty much the limit, right? But I could lose $339. Well, let's see about bulletproofing that. Okay, if we were to take and bulletproof that, how would radioactive trading have to do that?
Well, I guess we'd have to guarantee a way that they could get the $339 back.
Okay, all right. Here's the deal: if you're unhappy with anything about the blueprint or the service, or you just don't like the way I part my hair, all right, which that's kind of funny because I'm completely bald. Right? but for any reason, go ahead and check out the blueprint. Okay, if you don't like it, send it back. We don't want you to feel as though that you've done business with radioactive trading and it was a bad experience. Okay, so go ahead and check that out on us as far as risk. Okay, the guarantee takes out all the risk, so you are bulletproof. Okay, All right, Mike. Let's see. We're just about finished here.
Mm-hmm.
Are there any questions that that you did not handle, or that you think would be interesting for the rest of the group to hear?
Yeah, Bill sent in an email the other day, and it was yesterday, I believe, and I'm bringing this up for two reasons. One, Bill sent in a discussion with you about an article that you discussed about maybe using the weekly options. I don't think you've quite finished that yet, and the reason why we didn't answer Bill is I was waiting to see where you stood on that article, of course. But Bill wanted to know about the weekly options. You know, just that income method number one, selling the call against it, maybe some of the other ones. Is it better to use weekly options or try to force yourself into weekly option securities to get better returns, bulletproof, faster? Well, in theory, yes. But in practice, so far I haven't been able to prove that. And the reason why is you still need to follow the rules in the blueprint. There are ways to do the income methods wrong. You think you're familiar with covered calls. You've done a married put. You say, okay, I'm just going to go ahead and sell a call. There's a way to do it wrong that can get you into more trouble. If you sell the call too soon, you sell it below the put strike price, you can actually increase your risk on the upside, the direction you expected the stock to go. So the weekly options, in theory, should give you a better annualized premium if you're doing some of these income methods week by week instead of month by month. But in the long term, you still have to follow the rules. So even though you're doing a weekly series, you might not be able to sell a call or do an adjustment week by week. You still have to follow the rules to when it makes sense to make an adjustment.
Yeah. I've found that by and large I haven't been able to play the weeklies as efficiently and as well as and get as good returns than with just the monthlies, and that's actually good. That means less maintenance.
That's right.
it means I'm not glued to my computer screen all the time.
Yeah, Gary had a comment, and it was brought up by two other customers as well. Gary wanted to know, is this recorded? We had a customer who joined us late, wanted to know if it was being recorded. I did record this presentation. I hope to have it available in the archives in that webinars list on radioactivetrading.com late this afternoon or early tomorrow morning. I still have to wait for it to convert, and then we have to put it into another format and then load it up onto the site. So depending on my schedule this afternoon, we may get it up by this afternoon, or it should be available tomorrow morning.
Very good. Okay, Mike, in closing, I'm going to just recommend to everybody, hey, go ahead, get it right now. If you haven't made up your mind to get the blueprint, you know, what's really stopping you? There's no risk. It's $339 is how much you'll spend, and you'll be able to get that back if you decide that the blueprint isn't for you. But many of you stayed all the way to the end of this presentation. And I think it's because we're giving you something valuable. Go ahead and watch it again, and or watch one of the other archived webinars. We do give away a few, not all, but we do give away a few of the income methods and some of the management techniques. But the blueprint is a document that's well worth it. It's been earned, you know. My own blood, sweat, and tears, and yeah, capital. And a lot of networking with radioactive traders from all over the world have gone into the further improvements that the blueprint has undergone over the last almost a decade. So, okay. All right, Mike, it's been good chatting with you again. And,
we'll see you on Tuesday, I suppose.
Yep. I'll be seeing you on Tuesday, and between then and now, everybody, we'll see you out there in the market. Happy trading, and bye for now.
The